Intel is trading at 24.82 per share right now, which is a decline of 1.2% since the opening bell this morning. While the broader tech sector is showing some resilience, Intel is facing some localized selling pressure that seems to stem from updated projections regarding the yield rates on their latest manufacturing node. Many people see this price drop and think it is just another chapter in a long history of disappointments. But if you look at the order flow, there is a different narrative forming. We are seeing significant buy blocks coming in at the 24.5 level, which suggests that larger players are using this dip to build positions, while retail investors are being shaken out by the news cycle. This creates a fascinating tension between what the public believes and what the actual data is showing us about the company's long-term viability. The common belief right now is that Intel is a titan that lost its way, trapped between the massive success of its competitors and its own internal struggles to modernize its factories. People see the rise of other chip designers and assume Intel is destined for the scrap heap of history. However, the reality is that we are witnessing a massive structural shift in how the company operates, moving away from being a pure designer to becoming a foundry that other companies rely on for production. This is a high-stakes gamble that requires enormous amounts of capital and years of patience. Today's price action is a reflection of that impatience. The market is reacting to the immediate costs of this transition, rather than the potential cash flows that will come once those factories are fully operational. If you look at the recent trading volume, it is about 15% higher than the 30-day average. This indicates that this is not just a quiet drift downward, but an active battle between buyers and sellers. We are seeing institutional activity that looks like a classic rebalancing. Some funds that are sensitive to short-term earnings misses are exiting, while value-oriented funds are stepping in. This is why we see the price bouncing off that 24.5 support level repeatedly today. It is a tug-of-war, where the bears are trying to push it toward new yearly lows, while the bulls are defending the idea that the worst of the manufacturing delays are already priced in. Comment below how many shares of Intel you currently hold, or if you are waiting for a lower entry point. I am curious to see if the sentiment in our community matches the selling we are seeing on the tape today. Looking at the short selling data, there is something very interesting happening under the surface. Current short interest is sitting at roughly 95 million shares, which is about 2.2% of the float. On the surface, that doesn't look like a high-conviction short play. But when you look at the borrow rates, they have recently ticked up from 0.25% to nearly 1% in a very short window. This usually means that the availability of shares for shorting is tightening, or that brokers are anticipating a period of high volatility. We are also seeing a rise in fail-to-deliver data from the previous month, which often suggests that some market participants are struggling to locate shares during high-volume sell-offs. This does not necessarily mean a short squeeze is imminent, but it does mean that the bearish side of the trade is getting crowded and more expensive to maintain. Retail sentiment on platforms like X and Reddit is currently very divided. You have one camp that is convinced that the government subsidies through the CHIPS Act will essentially floor the stock price, making it a safe bet. Then you have another camp that points to the massive quarterly losses in the foundry segment as proof that the business model is broken. This creates a lot of noise, but if you focus on the institutional filings, you can see that firms like BlackRock and Vanguard have actually increased their positions slightly over the last quarter. This suggests that the smart money is more interested in the strategic importance of Intel to national security than they are in the next quarterly earnings report. What is your take on the rising short interest? Do you think the smart money is shorting the technical breakdown, or is this just manipulation to get retail to sell their shares?
Now, let's look at what the company actually does for those who are new to the ticker. Intel is essentially the backbone of the personal computer market and a major player in data centers. They design and manufacture the central processing units that run the vast majority of the world's laptops and servers. For decades, they were the undisputed leader in both design and manufacturing. But they hit a wall when they struggled to move to smaller transistor sizes, which allowed competitors to take significant market share. Their current strategy involves opening up their factories to build chips for other companies, effectively competing with firms like TSMC. This is a massive shift in their business model and requires them to be world-class at manufacturing again. The older reports show that the company has been burning through capital at an intense rate to build these new facilities in places like Ohio and Arizona. While this looks bad on a balance sheet in the short term, it is an investment in physical infrastructure that few other companies on Earth can replicate. Past performance has been lackluster, with the stock price stagnant or declining over the last several years while the rest of the tech sector soared. This has led to a deep sense of frustration among long-term holders. But this is exactly where the expectation versus reality gap is at its widest. The expectation is continued stagnation. The reality is a company that is fundamentally rebuilding itself from the ground up. In the coming weeks, you should be monitoring the options open interest, specifically the put-to-call ratio. Currently, we are seeing a heavy concentration of puts at the $22 strike price, which suggests that traders are hedging for a further drop. However, if the price stays above $24, those puts will start to lose value rapidly, which could force a bit of a relief rally as those hedges are unwound. You should also keep an eye on the days to cover metric for the short positions. If it rises above 5 days, any positive news about a new foundry partner could cause a very sharp move upward as short sellers scramble to close their positions in a thin market. The future outlook for Intel depends almost entirely on their ability to execute on their 18A manufacturing process. This is the point where they expect to regain leadership in the industry. If they can prove that their yields are high and their performance is superior, the floodgates for third-party foundry customers will open. If they fail, the company may be forced to split its design and manufacturing arms entirely. This is the ultimate catalyst for 2026. The risks are clear: technical failures, further delays, and intense competition from specialized AI chip designers. But the opportunities are equally large: a return to dominance and a role as the primary chip maker for the Western world. The macroeconomic environment is also playing a huge role here. With interest rates remaining a point of contention, the cost of financing these multi-billion-dollar factories is a constant headwind. Any sign that the central bank is becoming more accommodative would be a huge win for Intel because it lowers their cost of capital. Conversely, if inflation stays sticky and rates remain high, the pressure on Intel's balance sheet will continue to mount. This is why you see the stock trading so closely in line with the 10-year Treasury yield lately. It is as much a play on the economy as it is on technology. To manage your risk responsibly, you should be looking at the short interest data on a weekly basis. If you see the borrow cost spike above 2%, that is a signal that the bears are becoming aggressive. You can find this data on various financial portals, and it is a key indicator of how much pressure is being put on the stock by institutional short sellers. Do not get caught up in the hype of a short squeeze, but use it as a tool to understand where the market sentiment is truly leaning. Coordinated short attacks are rare, but thematic selling is very real, and Intel is currently in a sector that is being scrutinized heavily. As we look towards the end of the month, the tension between what investors expect and what Intel is delivering will only grow. Most are expecting another set of lackluster numbers and more talk about the distant future. If Intel can provide even a small piece of tangible evidence that their new factories are ahead of schedule or that they have signed a major new customer, the reality will far exceed those low expectations. This is how significant price reversals begin. They start when the consensus is at its most pessimistic, and the news starts to turn even slightly less bad than expected.
In summary, we have a stock that is currently down at $24.82, feeling the weight of market skepticism and technical selling. The expectation is that Intel is a fading giant that cannot keep up with the pace of modern innovation. The reality we have explored is a company undergoing a massive, capital-intensive transition that is making it more important to global infrastructure than ever before. We see institutional support at lower levels, a manageable but interesting short position, and a retail base that is looking for a reason to believe again. Do you think the major short sellers are right this time, or are they just pushing fear to get a better entry point for themselves? Your perspective on this is important because it reflects the real-time sentiment that drives these markets. Ultimately, the depth of this analysis shows that Intel is not just a simple buy or sell. It is a complex story of industrial rebuilding and geopolitical strategy. The contrast between the current price and the potential of their foundry business is where the opportunity lies, but it requires a level of patience that the modern market rarely possesses. We will continue to monitor the technical levels and the short interest data to see if the bulls can hold the line at $24 or if the bears will succeed in pushing it into the low 20s. Stay focused on the data, ignore the noise of the headlines, and remember that the biggest moves happen when the reality of a company's progress finally catches up to the market's low expectations. Intel is trading at $24.82 per share right now, which is a decline of 1.2% since the opening bell this morning. This price point is becoming a critical level for both the long-term holders and the short-term traders. If we look at the daily chart, we can see that we are approaching a zone that has acted as a floor multiple times in the past year. The volume today is reflecting this tension. We are seeing a lot of churn, meaning shares are changing hands rapidly without the price moving significantly in either direction after the initial drop. This usually happens when buyers and sellers are in a state of equilibrium, waiting for the next piece of news to break the tie. The institutional activity is particularly telling today. We are seeing a shift in the type of buyers. While the high-growth funds are backing away, we are seeing interest from sovereign wealth funds and large pensions. These are organizations that operate on decades, not quarters. They are looking at Intel and seeing an asset that is vital to the global economy. They are not worried about a 1% drop on a Thursday in January. They are looking at the fact that in 5 years, the world will need more advanced chips than it does today, and there are only a handful of places that can make them. This is the deeper reality that often gets lost in the daily noise of the stock market. It is also important to consider the competitive landscape. While Intel is trying to build its foundry business, they are still competing in the CPU market. Their latest chips have shown some impressive benchmarks, but the market is still skeptical about their ability to maintain margins. This skepticism is what the short sellers are feeding on. They believe that even if Intel can make the chips, they won't be able to do it profitably enough to justify their current valuation. This is the core of the bear case. They see a company that is spending more than it is making, and they bet that the trend will continue. However, the counter-argument is that the government is essentially backstopping this industry. With the amount of capital being injected into the semiconductor space for national security reasons, it is unlikely that the leading domestic manufacturer will be allowed to fail. This doesn't mean the stock can't go lower, but it does create a different kind of risk profile than your average tech company. This is why you see so much debate on social media. People are trying to weigh the technical weakness against the fundamental importance of the company. As we wrap up this analysis, keep an eye on the closing price today. If Intel can recover some of its losses and close above $25, it would be a strong signal that the buyers are winning the battle for this level. If it closes near its lows, we might see more pressure tomorrow as the weekly options expire. The key is to stay informed and not let the daily swings dictate your entire strategy. Look at the borrow rates, look at the institutional filings, and keep a close eye on the technical support levels. The gap between expectation and reality is where the most insightful investors find their edge. Would you like me to analyze the latest institutional filings for Intel to see which major funds are buying this dip?